a little bit about Jocelyn Vasquez and introduce her. She is a wonderful, I love everybody. I was just going to say she's a wonderful individual who I've known for several years. She's our guest speaker who actually works with the, it's known as MG. I have to read this out loud. MGIC, which is the Mortgage Guarantee Insurance Corporation. She is basically the Oz behind the curtain, and her company is Oz behind the curtain, where when buyers come to get a mortgage and they're paying less than that typical 20%, her company comes in and provides mortgage insurance. And Jocelyn has worked very closely with both Natalie and Marty throughout the years. They're two of our favorite lenders that we have here in our Los Feliz community. So Jocelyn, if you want to tell us how you got into the business, and I know you have your own little case study on how mortgage insurance works, the floor is yours.
Awesome. Thank you. Are you hearing that? Okay. Thank you so much for inviting me to speak today to Candace, Natalie, and David. I really appreciate it. So how I got started, honestly, I had just left the military. I served in the Navy. I was stationed in the East Coast and was moving back to California. And I had no mortgage experience, no background, and I ended up getting a job at a mortgage company as a receptionist. And I've always been the type of person that I love to learn. I love to grow. I love information. I believe knowledge is power. So little by little, I just started learning more about the process, asking questions, wanted to get involved with the mortgage process, and became a loan processor. So I started doing loans shortly right after I got the job, and little by little moved up the ranks, eventually became an operations manager. I did a little bit of underwriting, and I did originating, and as well as I got licensed as a real estate agent. So I did practice real estate simultaneously as I did loan processing. And how I got into private mortgage insurance, which I will talk a little bit of how that works and what is simply by just the experience that I had. I had worn so many hats, had been in the industry already by about 10 years, and I was looking for a change, and MGIC is known in the industry very well. They actually started the private mortgage insurance industry 65 years ago, so we are celebrating our 65th year this year. Yay. And I already knew right off the bat that they were a very well-known company that I wanted to work for, so I applied and I got the position. And so as Candace alluded, I am MGIC's account manager. I cover Los Angeles all the way up to the coast. So I cover Santa Barbara, San Luis Obispo, and the Central Valley as well. So I go to Bakersfield and Fresno. And I work with originators like Marty, Natalie, and everybody else who works in the mortgage side of lending. And so I'm going to share screen. I have a presentation that I'd like to share with you all. Before I get into the presentation, though, I'd like to share a little story of my own that kind of relates to this a lot. When I first began in the industry, like I said, I didn't know anything about mortgage lending, but as I started doing more mortgage loans, I started to see that becoming a first-time home buyer could actually be obtainable for myself. So I learned about down payment programs, mortgage insurance, and I learned that in the state of California, you could actually represent yourself as a realtor. So I got licensed as a real estate agent because I wanted to be able to use the commission towards my closing costs. And I utilized mortgage insurance to put less than 20%. And I bought my first home at 28 with as little as 5% down payment. And why that's a huge success for me is because that got my foot in the door. I was able to sell that home 3 years later. I built up over $100,000 in equity, was able to move up, purchase something bigger, and still utilized mortgage insurance because I was able to keep some money in pocket, get a better interest rate and get into the home that I wanted. So I believe that mortgage insurance is a powerful resource. It's one of the original low down payment resources that is available to anyone and everyone who qualifies for it. So it's something that I've used in my life that's helped me build financial wealth. I love it. I support it. And that's why I'm super passionate about what I do, because I think if more people know about it, more people take the steps to become a first-time home buyer, and they will see that it is obtainable. Because me at 28 by myself in LA, hello, that is a win, you know? So mortgage insurance is a benefit to the buyers, and that is what my passion is, to educate others about what is it, how to utilize it, and how you can get into homes sooner than later. So I'm going to go ahead and share screen. A little bit about MGIC. We were established in 1967. Our mission is to help buyers buy homes sooner and make lending safer for lenders, investors, and ultimately U.S. taxpayers. Just last year, we insured more than 412,000 home loans in 2021. And if you didn't know, 52% of purchase loans in 2021 had private mortgage insurance. So it's a huge segment of the market. And that is why I'm always saying that if you're not doing loans with PMI, you should really take a look at it, because it is something that is half of the industry out there, and it's growing. More people are having to put less than 20% because home prices are so high. And so we have insured more than 13.5 million households year to date. And just last year, we ended as the #1 mortgage insurance company. We closed out the year at 120 billion. And our competitor, the second one in line, was like 15 billion below us. So we are leading this industry, and we are #1 for the last 2 years, and we're very competitive, and we have a lot of resources to help originators stay on top of mind with their clients, their referral partners. We not only work with loan officers, I work directly with realtors on their behalf. I work with the processing team, the loan officer assistants, underwriting, everyone, because we each play a role in this industry. So, the more we all communicate, the better the transactions flow. No, it's not moving. I think my mouse died. That's nice. Okay, so what is mortgage insurance? I keep saying mortgage insurance, private mortgage insurance. However way you want to say it, it is the same thing. MI, private MI, PMI, it is all known as private mortgage insurance. And it is simply a financial guarantee that reduces the loss of the lender or investor in the event that the borrower defaults. A lot of times, borrowers have the stigma thinking that mortgage insurance is an insurance that they pay for their benefit. And it is a benefit to them, but essentially it's in place for the lender, for the investor who's lending on that loan when the buyer doesn't have the 20% down payment. But what is it really? Well, it is a tool that you can use to increase your buying power. It expands your cash flow options. It gives you lower monthly payments if you have a high credit score. You have less debt and more equity, especially when you compare it to an FHA, because FHA, and I won't get too much into FHA, but it is a form of mortgage insurance, but that's through the Federal Housing Administration. So it's a government program. Unlike us, we're privately owned by shareholders. So that's the difference. FHA also is for the life of the loan versus conventional private mortgage insurance. You can cancel after a certain time frame, and I'll go over that as well. So when you cancel it, you start to build more equity on your home. So again, you have the ability to cancel when you no longer need it. And how it helps borrowers and specifically and realtors is by increasing your purchase power. So say a buyer had $80,000 for a down payment. That's a 20% on a $400,000 home, which is great, but we all know home prices are way higher than that right now. So how you can utilize mortgage insurance is you can actually double that purchase power. You can go up to an $800,000 house, only put 5% of that 80,000, which will be 40,000, and you get to keep 40,000 in your savings, or use that towards your closing costs and, you know, upgrades for the home, repairs, etc. How MI is paid for by the buyer is two ways. There's a bar paid MI option, and there's a lender paid MI option. And the monthly premium, there's a monthly premium and a single premium. The monthly premium has no upfront cost. So unlike FHA, there's an upfront cost that the buyer has to pay for. We don't have that. So you don't have to pay anything up front. You pay it monthly on your mortgage payment. And like I mentioned, it can be canceled. A single premium is paid all up front. So it's basically when you go to your insurance company and you get a premium for the annual, for the year, it's kind of the same concept. It's a single premium that the borrower will pay one time at closing. They can either pay it out of their own funds, or if the seller is for some reason giving them a seller concession credit, they can use that to pay it. Or if the lender / bank is giving them a credit, they can also use that credit to pay it. We don't care. It could even be all three to pay out that single premium, as long as it's paid in full at closing.
Can I pause for a second?
Yes.
So just to give you guys a little knowledge on single premiums and how we sometimes advise clients, right? So single premiums are a little more expensive upfront. They can be large fees, a single premium. So sometimes I don't recommend it, because depending on how much a person is putting down, mortgage insurance isn't that expensive these days. And to pay a huge premium upfront as one large lump sum, it sometimes doesn't make sense, especially with how values in Los Angeles are going up. If you pay a monthly of $80, you really only have to keep mortgage insurance for 2 years. So then you're only paying 2 years of $80, right? So what is that? 960 times 2 is 1,900, right? 1,900 bucks in 2 years. And for sure, you're going to have 10% equity, basically. I mean, the chances are like 90% you're going to have 10% equity in another 2 years of waiting, and even sooner most of the time. And then you can get rid of mortgage insurance. That's what's so incredible about conventional mortgage insurance, is it's not something that's forever. The way FHA mortgage insurance is forever. You can't get rid of it. So anyway, I just thought I would give a little bit more insight on how I price clients with single premium. The only time I've really ever done a single premium is when my debt to income ratios are so tight that the borrower can't afford mortgage insurance. Like, he does not have any room in his debt to income ratios to handle that extra payment per month. That's when we do a single premium, or like Jocelyn will probably explain soon, a split premium. To get the payment to where he can handle it, and then pays like half and half. So I'll let her explain that. But that's just a little insight as I'm listening.
Yeah, no, definitely. It's not something that everyone's going to want to do, because they are more expensive, because you're paying the whole mortgage insurance up front for what it would have been, if you would have had it the 5 years or 4 years, however long you had to have it. So it is going to be essentially higher than the monthly. And like Natalie said, our monthlies are so affordable. They've become so affordable that it is a better option 9 out of 10 times. When I see that it is a better option is typically when it's like less than 85, like between 81 to 85, a single premium isn't that much. So it may be when you want to utilize it, or when you finance it into the loan, which I'll give an example on how to finance the single premium so that they don't have to come in with that large premium amount out of pocket, because it can be a lot. But it is an option, and a portion can be refundable if you cancel it within a certain time frame. We do have a refundable option, but again, they get more pricier. So I always say single premium, non-refundable, because they're already high as it is, but it is an option. We have lender paid single premiums, which you can roll into the interest rate. With how the market is right now, we don't see like very low minimum of these because the interest rates people are trying to get as low as they can. So they're not trying to take a higher interest rate in today's market. So this is probably like less than 1% of our business out there. Lender paid, but it is an option where, again, you can take the interest rate higher, you can roll in that premium into that higher interest rate, and then you don't have to pay on it monthly. Before I go into this page, I will say I'm not going to talk about splits, Natalie. Thanks for bringing that up, because it is, again, less than 1% of our business. And most of the times you're going to have a better option to go with a monthly than to do a split. It just doesn't make sense on most loans, and it's not a benefit to the buyer, but it is an option out there. And how that basically works, a split is just like a single premium that we give a dollar amount, and you can pay a portion, like a quarter up front, and then the rest gets rolled into a monthly to the loan. So there's tiers of how much you can pay: a quarter, half, a whole point. It just depends. And then the rest gets broken out into a monthly. So like she alluded, if the buyer's debt to income ratio is really tight and you just need that payment to drop a little bit, then you can look into a split. But most of the time, we don't have to do that. Or most of the time, loan officers don't do that option. It's very little of our business. And then how mortgage insurance can be canceled: 2 ways. One is you're using your original value. So based on your original value, when you close that mortgage loan, once you get to a 78% loan to value, it automatically cancels. So there's nothing you need to do as the buyer. You just wait till it gets to 78% loan to value of your original price or value, and it'll automatically cancel, and you won't have to pay that additional monthly on your mortgage payment. Or once it gets to 80% loan to value, the borrower can actually call their servicer company and ask for it to be canceled. And as long as they have good payment history and that servicer doesn't have any extra requirements or overlays, then they'll be able to go ahead and cancel that mortgage insurance, which sometimes honestly can save you a good year worth of payments. So it's really important that you're aware that mortgage insurance can be canceled and that you're on top of it, because as soon as it reaches 80, they won't call you. You have to call them. They'll let it go till 78% and you'll keep paying on that. So it's really important to know when that is. And the second option is to cancel it using current value. And as we know, the values have increased so much throughout the last 2 years that this is a hot topic right now, because you can potentially cancel sooner than later. And how it works is Fannie Freddie, the agencies, require that the loan be seasoned for at least 2 years if you're going to use current value, and that the borrowers have had a good payment history. And if they have been at the property for 5 years or less, they can cancel it with 75% loan to value. Or if they've been at the property more than 5 years, then they can cancel mortgage insurance at 80% or request for it to be canceled with the current value. So that's really important to know. And I wanted to share an example of how you can use mortgage insurance to actually increase your purchase power. So when we look at a monthly versus a BPMI single, and I'm sure that this is what all loan officers are doing, they're looking at both options to see what their best is, like Natalie said. This is kind of a way to look at it. So say the borrower was going to use a monthly, and they're at a 90% loan to value. They have a 740 FICO. The rate's 3.125. The purchase price is $500,000. They're putting 10% down. The loan amount is at $450. Their payment and interest would be $1,928. If you add a monthly MI, in this scenario, you're looking at $94 on a monthly. You're going to end up paying $2,022. Not bad. If you go to a BPMI single and you finance that, you're still going to be at a $500,000 purchase price you're going to put 10% down, which is 50,000. You're going to remain at 450,000 the loan amount, but you're going to take that single premium, which in this case would be $4,767. You would roll it in and finance it into the loan amount, leaving you at a $454,767 loan amount, giving you a payment of $1,948. So it's actually lowers your payment by $74 by financing that single. So if the buyer in this case is okay with financing that, additional $4,000 into the loan amount and is okay with the payment at $1,948, they may in this case say, hey, a single is a better option than a monthly. Or maybe they want to pay on it monthly. They can stick to the 2022 and pay on it and then cancel sooner and not have to pay that full lump sum of $4,767. And then how you use that to increase your purchase power is, so say you are okay with that payment and you're okay with financing that amount, then you can actually even take the purchase price to $520,000. So now you've increased your purchase power by $20,000, and you are still putting in 10% down payment, which is only $2,000 more of your original $50,000. You would have a loan amount at $468,000, and you would take that $4,914 single premium at that new loan purchase price, new loan amount. You would roll it in, and your payment would be $1,948, which is we're a payment and interest, which would basically leave you at $2,026 with financing everything, which is only $4 higher than what you originally had quoted at a $500,000. So if the buyer was okay with the payment at $500,000, which was close to $2,000, they're going to most likely be okay with increasing the purchase by $20,000 and still being at that same $2,026. I have 4 examples on why private mortgage insurance is a benefit to home buyers or homeowners. One of them is it gets you into the home sooner than later. So if a buyer wanted to buy a house today and they had, sorry, this is in the way of, I can't see it. Okay, so the amount of time that you buy, so say you wanted to buy a home sooner or later. This is an example. Example number 1 is you can actually get into a home utilizing mortgage insurance in 3 years versus 11. So say the person makes $93,000 of income. They're looking to buy a house for $257,000. They can actually buy in 3 years utilizing mortgage insurance, putting 5% down payment instead of waiting. If they waited to get that 20%, which a lot of buyers always say, I'm just waiting to get that 20%. I want to avoid mortgage insurance. This is that primary example of if you continuously wait, which is, it's obviously up to them to wait, you're going to end up waiting, 10 plus years. In this example, they'd be waiting 11 years to save up that 20%. When utilizing mortgage insurance, they can buy in 3 years. So that's one benefit to them. The second one is they increases their home options. If they had they had $10,000 saved up, they can buy a $50,000 home at 20% down payment. But why would anyone want to buy that? You can't buy anything with $50,000. So if you take that $10,000 and you actually double your purchase power, now you're able to buy a $100,000 home by only putting 10% of that $10,000. Or you could take it a next step further and you can increase to 3 times that amount at $200,000, putting 5% of that $10,000. So it really does double, triple your purchase power. So that's a huge benefit on why buyers need to consider using mortgage insurance. The third example is you just get to keep more in your savings. So if you had $40,000 and you wanted to use that as a down payment, you would be using that $40,000 and putting it down on a house of $200,000, and it'll leave you 0 in your savings, which nobody wants to be leaving their savings at 0 when they're purchasing a home. So that would be, not a good situation to be in. But the benefit of using mortgage insurance, again, you could put less down. So you would put out of that 40, you'd put 10%, which would be 20,000, and that leaves you 20,000 in savings. Or you can Oh, I think it's going back. Sorry. And my mouse died. Perfect timing. Or you can put less than that. And then the last option that I wanted, example that I wanted to say is you just take advantage of home appreciation sooner. Like I mentioned, FHA will be on the loan for the life of the loan versus conventional. As I mentioned, you can cancel it sooner. So you would just be able to cancel it and start building that equity and keeping more of that equity in your pocket. So that's what I wanted to say. So feel free to follow MGIC on any of our social media accounts. We constantly are putting information out for you to be aware of any new programs that are out with us, or if we have resources to help you in your business. We're always staying very active on our socials. And that's what I wanted to share. So if anybody has any questions, I'd love to answer.
Jocelyn. Actually, we do have a question in chat from Clint. Clint was asking about what credit scores do you prefer?
Oh, we go as low as 620 in our credit scores.
How much was that again?
We go as low as 620. So as long as you have a FICO of 620, you should qualify for mortgage insurance. Obviously, the higher, the better. If you have a 620, it's going to be pretty expensive, but we go as low as 620.
Okay, thank you.
Mm-hmm. Anybody else?
What about loan outside the California?
What if you're outside of California?
No,
so
what about the loan that you're getting outside California? Is that going to be also the same? It does apply?
Yeah, we are nationwide. So MGIC is not just local to this area. We work everywhere in the United States. We cover Hawaii, Guam, Puerto Rico. So we work all throughout the nation.
Thank you.
Mm-hmm.
Oh, and Jocelyn, generally, is this good for like a single family home, or could somebody potentially use this if they wanted to buy investment property? What type of property type is this eligible for?
That's a great question. Yes, we actually cover all residential properties. So any 1 to 4 units, we will insure.
And does the owner need to live in the property?
We cover primary. We used to do investment. We stopped it during the pandemic. We haven't brought that option back, but originally, yes, we were insuring investment homes. So you didn't have to necessarily live at the property.
Because I have clients who are actually, they have their house and they're looking to buy a second property, and they would not own or occupy that.
Yeah, so we are not doing it. I know some of our competitors are still doing investment homes. I haven't heard that they're bringing it back anytime soon, but hopefully soon.
Okay, so then if it's a 2 to 4 unit property and the owner lives in it, you could do, is it true as long as the owner lives in it, you're able to do that MI insurance or PMI?
Yes, up to 4 units, primary.
Thank you.
What about relatives?
What about what?
Relatives.
You can live, that also counts as a owner occupied?
Rentals?
Close, like, children or something, they can.
Relatives.
They qualify for that?
Relatives qualify. Anyone can qualify for mortgage insurance.
But if the property is under your, let's say me, for example, I'm buying it, and then my child or my, brother or whatever decides to live there, would that be considered? Would they qualify? Could we qualify under that realm?
Are they taking over the property as a primary?
No. Well, I'm guessing. Jacob, is that your question? I'm sorry.
Yeah, that's exactly what I was want to know. Let's say you buying it, but your child lives on the property. Is that also count as you would live in there? Is that, or
Mm, no, I don't think so, because if they're not going to be on the loan, then they're not technically primary, and you are, and you're not living at it. So no, that wouldn't qualify as a primary. It'd have to actually be the person that's on the mortgage loan living at the property. I mean, if you're transferring the property to your relative, then that's a different story, because yes, then that person becomes the primary and it's within family. So yes, we would insure that.
thank
And Jocelyn, what compared to, well, PMI back in the day, when I say back in the day, let's say 3, 4, 5 years ago, maybe even longer, it used to be a lot higher, correct? Am I, yeah, so it's, things have shifted, because I know, I even remember back, when I first got into business, PMI was the, let's just say it was definitely the ugly looming thing over the mortgage. It's, oh my gosh, you have PMI on top of it, and I think that the rates are almost double what they are now. Am I correct to say that?
Yes. I mean, my understanding, because I got into the business afterwards, but my understanding is that it was significantly higher. So that's why a lot of people were unattracted to it. They were like, I don't want that additional payment, but it's become so affordable in the last decade that sometimes you're paying like 0.16, up front or on a monthly, which is nothing. 0.16 on the loan amount, which is nothing compared to back then. So, yeah.
That's what I thought, because that's, I have clients that are, once I mentioned PMI, they run for the hills.
Yeah.
But I tell them, things have changed, and, the pricing now is probably half of what it used to be. So, okay, I just want to make sure I'm not
Yeah,
peddling false information.
Super affordable. And like I said, even compared to FHA, it's so affordable compared to FHA, because FHA requires that you pay an upfront fee. We don't have that. So not only are we affordable monthly, but we don't have that upfront cost to the buyers. So, and we can cancel sooner than FHA. So it's become very convenient. That's why when I purchased my second home, I didn't hesitate for 1 second to take on mortgage insurance again, because I knew I was going to put 15% down. So I only needed to build up a 5% equity, and like that was going to happen in a year anyways. So I bought 2 years ago. I'm already due for almost canceling my mortgage insurance, and the payment was like $100. So I mean, really, when you look at it, I got to keep like $25,000 in my pocket, and I only had to pay $100 each month for like 2 years. It's not bad.
And who is it that chooses a mortgage insurance company? Is it the lender, or what, how does that go about? What's the process behind that?
Yeah, so most mortgage bankers have it set up where the loan officer gets to choose it. There are some banks that kind of allocate it, and they dictate which mortgage insurance company they go with. But most of the time, it's the loan officer's decision on who they want to go with.
Okay.
So that's my job, is to build those relationships with the loan officers, so that they, call me if they have any issues or if they need anything, so that I can help them with their business, and that they would choose MGIC when they go to choose MI.
Wonderful. Okay. Thank you so much. I appreciate the input.
Yeah, and then just so you know a little more of how the behind the scenes works, a lot of people don't know this, but once you've applied for mortgage insurance, there's a whole approval process that happens behind the scenes. So not only is the loan officer taking that application and sending it through their process and getting the borrower approved and cleared to close on that loan, but at the very tail end, once they've completed their due diligence, and they've gotten all the reports and all the assets and all the credit report checked and everything, they have to submit, most bankers submit a full package to MGIC, for example, and we have to review that whole loan and do our own approval. And then once we approve it, we issue out a certificate and then they can go ahead and close that loan. So it's very important for the loan officers to know who I am and to reach out to me, because sometimes they're in a time crunch, they're past their contingency period. So they're looking to get loan documents ASAP. So I'm able to go behind the scenes, rush that review process so they can get loan documents out to the buyer so that they can close. But I will say our turn times have become extremely well. We're at 24 to 40 hours or less. And if you get me involved, I can potentially request a rush, and we're at 4 hours or less.
Oh,
So,
wow.
yeah. So it's super important to know what kind of happens behind the scenes, because a lot of people on the front end don't know that. So they're like, what's going on? What's happening? Why do I have to wait for another approval? It's just the name of the game. We also have to do our due diligence and make sure that that loan is sellable to the agencies and that the bank has done their job, so that we can insure that loan and be okay with taking that risk on, allowing the buyer to close on that purchase.
Got it.
Mhm.
Perfect. Thank you so much. That's very helpful. Good to know.
I have a question in the chat. I hope I'm conveying this properly. So how about, I'm losing my voice, excuse me. Sorry. How about on the second homes that are not being rented? So I guess it would be somebody's second home, maybe a vacation home outside of the area.
Yes, we do second homes. We do second homes, primary homes. We were doing investment homes. So yes, if you have a second home, we do insure those.
Oh, that's great to know. And then how about if somebody wanted to do a cash out refi?
Yes.
You can do that if they apply for a cash out refi?
Yes, if the loan is over 80 and they're taking that cash, we don't have any specific requirements, like they can't take cash out. Anytime it's over 80, as long as it's above 80%, we're going to have to insure it anyway. So yes, we do all of that. Cash out, rate and term.
See, that's amazing. See how flexible this program is, how it makes home ownership affordable, how we can buy more doors. This is why we do this, people. This is very exciting to me. I hope it's all exciting for you guys as well.
And like Candace said, we're behind the scenes. So even all those down payment assistance programs that you hear about, CalHFA, I don't know, the doctor's programs, the nurse programs, all those down payment assistance programs that everyone talks about, in the back end, the only reason they're able to offer those programs is because they are partnering with the mortgage insurance company behind the scenes to be able to take on that risk. So there is that process. Once again, at the very tail end, once you've gone through the loan approval with the mortgage banker and it goes into this down payment assistance company, they do their due diligence and then they send it to us. That is why a lot of people don't want to deal with those down payment assistance programs, because yes, they take a long time because there's a lot of people involved. But if you're a qualified buyer, there's no reason to hesitate, because these programs exist for a reason. They work, and you have companies like us that are willing to insure those loans. So we work with down payment assistance companies so that more buyers can go out there and start creating financial wealth and become a first-time home buyer.
And it's not only for first-time home buyers.
It's not. And going back to what David was saying, when it comes to down payment assistance programs, we're even more affordable, because when we partner with those down payment assistance company like CalHFA, for example, we actually reduce our coverage levels. So therefore, that monthly becomes even more affordable. So.
Well, you did mention that rates now are lower than they were about 10 years ago. Why are rates lower now?
Just the market, to stay be competitive with the market. We've just had to lower our monthly and become more competitive. And yeah, it's just kind of the name of the game. We also went on risk-based pricing. Back in the day, a PMI used to have like these rate cards, and you would be able to just look at a card and know, okay, this is the FICO, the amount of buyers, this is what the payment's going to be, but now in the last 3 years, all our competitors, including us, have gone into what's called risk-based pricing. So it's become more based on your credit score, your purchase price, your loan amount, your debt to income ratio. Like now we look at every single factor of the loan, how many buyers, because the more buyers that are on that loan, it's actually, it looks better for us because there's more people making that mortgage payment. So therefore we actually give a credit when there's 2 or more buyers. So it becomes even more affordable. So, yeah, those, so how it's changed now, it's called risk-based pricing, and you have to qualify, and we look at every single spec of the loan or details of the loan.
Based on what you're telling me, it almost sounds like it's going through almost 2 underwriting processes, first with the mortgage banker and then also with you guys.
Yes. And that's what a lot of people don't know. A lot of people, realtors especially, because they're on the front end, they're not sure of what's going on behind the scenes. And they're thinking, I thought the buyer submitted all the documents. Why are we still waiting? Because there's a due diligence that the mortgage insurance has to do, or mortgage insurance company has to do as well. And like I said, their turn times are pretty good, but yeah, when you don't know what's happening, a day or 2 can seem like an eternity. So that's why I try to always say, like, if you need a rush, let me know, because I get it. I get that sometimes 2 days can be a long time. But when you think about how much what we're doing behind the scenes, it's pretty standard turn time.
Well, you mentioned it could take you a couple days. So what I'm hearing or what I'm thinking is it almost takes less time for you and your organization to, so it's not officially loan approval. You just approve the fact that you could give the PMI insurance.
Right.
We look at everything that the mortgage bank will look at too. That's why we're at the tail end. A lot of people think, why can't you submit to the mortgage insurance company earlier? Well, because we won't have the full loan file until the banker or the loan officer is done everything on it. So that's why it kind of has to be at the very tail end.
But that makes sense.
That's why it's also important to have a relationship with your account manager, because if you do need to pull some strings, then I'd be the person that you go to.
Okay, cool. No, I appreciate that. And I'm still looking at the chat. Somebody wrote in, what happens if the property goes into foreclosure?
Then whatever their bank, they would deal with the bank at that point. Although you pay us monthly, like you said, we're behind the scenes. So once we become part of the transaction, once we've approved it and we've closed on that loan, it's kind of like we're in the back end. You don't pay us directly, you pay your servicer. So whoever you're working with when it comes to your servicer and you're making those payments, that's who you would work with when it comes to foreclosure. If you stop making those payments, you would never come directly to us. The bank would come to us and notify us that loan is in foreclosure.
Right, and you get the typical notices, and is it 90 days to cure? And if not, you get a couple chances, and then all of a sudden the big notice comes up on your door.
Yes, exactly.
I don't mean to be smiling when I say that, but there was a period in time where this was common practice back in life.
We're behind the scenes in every way, like in the back of the loan. You never really deal with us up front. The bank always is the one that's dealing with us. But it's good to know. It's good information to be aware of, so that if you do have questions, you can always reach out, or you can reach out to your loan officer and ask about cancellation and your servicer, but that would be dealt with your servicer.
Right. Let's see, what else do we have here? So
I was just curious, are you guys kind of like auto insurance or any insurance company where you know, there might be higher risk people and you will say, okay, no, we're not ready to insure this person, but there are other companies that might at a higher rate?
Yeah, absolutely. We are like that. There's only 6 of us nationally, and we each look at risk differently. You know, MJC has been in the business the longest, so we try to be a little conservative and try to see what works for us. Because at the end of the day, those loans that we close on, that we insure, they stay on our books for so long. You know, up to 5 years. So we want to make sure that our whole portfolio isn't full of 620 FICO scores, you know? So we try to kind of gauge it and try to stay, like I said, conservative, but still very competitive, because we are the #1 mortgage insurance company. We have been the last 2 years. So we're not off. We try to be very competitive. And so we try to take on risk with everyone. You know, we try to take on 620s, 700s, 800s. Obviously, we want all the high ones. So that's what you'll find us priced very well. But we're not going to always only get 800. We work with everyone. So
Okay, good to
Yeah.
know. Thank you. Let's see, what else? What other questions do we have?
There's another question that says, what if we have another drop in value like we did in like 2007, 2008, 2009? How was value calculated then? Does that even affect the PMI at that point?
I mean,
Oh yeah, if values go down and then all of a sudden it's like, hey, I've got my 80% equity, we can like cancel the PMI.
if you're at 80%, yes, you can request cancellation. If the values were to go less than that, I mean, and you were upside down, is that your question? It's not going to affect.
Yeah, they did not mention being upside down, but say you buy a property for like
$5 million property, you're, you know, yeah.
and then all of a sudden it's
paid off
worth
80%, but now it's worth
3.5.
Yeah, you know, it's worth a lot less. How does that work exactly? How do you guys estimate 80% of, you know, being paid
Well,
off?
I'll start here that very rarely do you have mortgage insurance on those kind of massive jumbo loans. Normally you don't.
Yeah.
All right, fine. Let's drop
So
the.
how about if it's like 800,000 property? Something nice in Palm Springs, for example.
Right.
Have you been to Palm Springs
100,000.
lately? Do you know how expensive it is?
Palm Springs.
And
Yes.
the conventional loan limits are much lower in Palm Springs because it's Riverside. So you can't even go to 970 in Riverside.
Oh, really? Oh, that's right. Yeah, that's true. Yeah.
Yeah, the
But
700 loan is jumbo there. So
Shit.
Once you
Wow.
actually have your mortgage insurance, though, I mean, correct me if I'm wrong, Jocelyn, once you have a mortgage insurance and you've already got an insurance issued, once you hit 80 and you can call and request, no matter what, if the values drop or not.
Okay.
But if, you know, but if it's newer, I mean, you could probably, that's my understanding, right, Jocelyn? Isn't that correct?
Right. You took out the loan like, you know, today, and then 6 months later, your property increased. You can't do it because you have to wait 2 years. It has to be seasoned for 2 years. But if you're on a monthly and your property, I mean, you say you got a big bonus or something. I get this question all the time. This is what I'm saying. Sometimes they're like, "With, I'm going to get a big bonus, and then can I pay off the principal balance down to make it to an 80 and then cancel MI?" Yes, you can. It could literally be 6 months after you've closed, 4 months after. Doesn't matter. As long as you bring that principal balance to 80, then you can request cancellation.
It just can't be based off of increase in value. So it just has to be you paying it down physically.
To the original, like 80% of what it would have been
Okay.
if you waited the time.
But the fact that the property value may have decreased, let's say, God forbid, their property values were to go down, that doesn't impact things either. It's based on the original loan and the original property purchase price and whatnot. So, okay, got it.
Yes.
That's great. Thanks for clarifying. So getting back to one point, it says, so it would seem that the PMI pays off the loan if in foreclosure. Well, no, I mean, it has to, I mean, if it goes into foreclosure, if it's foreclosed upon, if the property's foreclosed upon, then the MGIC would cover the lender's cost on that.
We cover, so there's tiers. And so depending on which tier you originally closed on, so say the buyer put 5% down, that's a 30% coverage on our end. So if the property were to be foreclosed on, 35% coverage. If the property were to be foreclosed on 2 days later or something, or a month later or something.
Just a year later, 2 years later.
Yeah, we would only pay 35% of what that lender's loss is going to be. And that's including interest, processing, whatever fees they have to tack on at the very dollar, the very end. We will only pay 35% of that loss. That's if you're in that tier. So there's 4 tiers. There's 12% coverage, there's 20% coverage, 25 and 30 and 35 coverage. So depending on how much you're putting down as down payment, that you would fall under one of those coverages. And that's how much we would pay out to the lender if the property does foreclose.
So the lender doesn't, in the case of a property being foreclosed upon, the lender doesn't even get their full reimbursement back on their loan.
Never.
So who's benefiting then?
The buyer.
The owner, yeah.
Yeah.
I mean,
How so?
second loan, that's who really gets screwed. So if there's ever a second, that's why 80-10-10s went away. Because when all of those foreclosures and short sales happened, the second lender never gets paid.
Yeah.
So
Okay, I'm just reading the, chat comments. So the lender's allowing this lower down payment on a marginal reimbursement.
Wait, is that a question or a comment? Wait, what was it?
I think it's a question. Because so I guess it's a question. Is the lender allowing this lower down based on a marginal reimbursement?
Mm-hmm. Yeah, they're allowing for the buyer to put less than 20%, and they're willing to take on that risk as long as the mortgage insurance company is willing to compensate on some of that risk. That's why it's like a benefit for them to work with us. And it's a benefit for the buyer to utilize mortgage insurance because they can get into the home sooner.
And if they don't have the mortgage insurance, they can't get a down payment for it and they cannot buy.
Mm-hmm. They can buy it, they save 20%, but in this market, they will probably be waiting a while to save that.
Very interesting. Thanks for clarifying. This is stuff that we don't really talk about in detail, whether it's like realtors and loan officers or even us with our clients, because I never feel fully equipped to like address questions like this. I always say, talk to your loan officer. They could, better guide you.
It just reduces risk for banks to take on more risk or give flexible options. So it's something that it was, brought on after a savings and loans debacle. And it was just basically because banks were very afraid to lend. And now because of Jocelyn and her company and many other companies, it's made it a lot easier for people to get into homes. It gives an alternative against the government loans that are out there, which is all fabulous, wonderful stuff. It's just a little bit cheaper to do it with Jocelyn.
Yeah. And if you hear about any like specific like niche products, a lot of times people don't know that and mortgage insurances are actually behind that risk factor. A lot of times these products are even available because of us, because we were willing to share that risk with the bank. So if they're willing to, make a 0% down payment program for their members or clients, however, then we come in to kind of give them a safety blanket and ensure some of that. And so we'll partner with them to create these portfolio products. So yeah, it's nice to know who's behind the scenes. Hi.
Definitely behind the scenes. Well, thank you so much. I mean, the bottom line here is, and we had this in our conversation, it's like, you and your company and people like both Marty and Natalie and us as realtors, we're all here to help create wealth through real estate. Well, thank you, everybody. Any more questions? Because I know Natalie probably wants to give a bit of a market update. Everybody's curious to know about interest rates. She doesn't. It is what it is. Here we are.
guys, not today.
Would you mind to give info? We don't.
Oh, yes. Yes, Jacob would like your information.
Mhm.
I can put my information on there.
If you would like, yeah, can you do that? You could.
She already did.
Oh, yeah. Oh, Natalie's. Yes, Natalie's is on there.
And Jocelyn too. Yes, but you're.
And Jocelyn, if you could add yours.
Okay.
Do you have access to that?
Yes, I'll put it on here.
Okay. Someone was asking. Well, thank you, everybody. Thank you so much, Jocelyn, for helping us navigate through the murky waters of PMI. I mean, it's really a great thing for buyers. And again, not just for first-time home buyers like what is commonly believed. It's great for investors too.
Absolutely.
Absolutely. Thank you so much for having me. It was a pleasure. I really enjoy educating people on it because I'm, like I said, I've used it in my life. I've seen the power of it. And it's a great product that a lot of people, like you said, David, are afraid of it because of
Yeah.
but we got to break that stigma, and we got to get the word out that it's actually a really good resource to create affordable housing. So thank you so much.
Incredible how many times I say to a client, or how many times a client will say to me, I don't want MI. I absolutely do not want MI. So whatever it takes to not have it. Because he'll say, I'll hear from people, I've got 17% down and I'm waiting to get the extra 3% so that I don't have MI. And you're like, well, how about you put 12% down, save an extra 5% in your pocket and pay $80 a month? Because you certainly can't borrow 50 grand for $80 a month, right? And that's how much you can potentially save from just having a little MI on your loan. It's such competitive rates now. They're so low. It's so sensible actually to not put 20% and save your money, especially I'll tell people on properties, all my, a lot of clients have the 20%. And I'll say, look, it's going to depend on what the property is like. Because what if you need a new kitchen or a new bathroom or new floors or something when you purchase it? Don't be afraid to save some of that money for renovation and just have a little bit of MI and put 15% down instead. It's so much more sensible to think of it that way. So we'll look at the numbers of 20% down, and we'll also look at the numbers of 15% down so that you understand what you're looking at. And then don't be afraid of a property that might need a new kitchen or, flooring, cabinets, different things like that. Because you don't have to be strapped for cash,
It's a strategy, honestly. Once you know about MI, it becomes a strategy. It's not like I have to have it. I want to have it because it's something that's going to make sense to me. Yeah, that's 15% down too. I was like, I want a new kitchen. So I'm going to put 15. I'm going to keep the rest of the money in my savings and get a new kitchen. Makes sense.
Yeah, totally.
We all leave this conversation a little wiser. That's why we do what we do. Well, I also wanted to let everybody know that when we celebrate our 3rd anniversary in April, that's going to be April 7th. How many people are familiar, obviously, with the Capitol Records Building and the Cinerama Dome? Everybody, I assume?
Never heard of it. What are they?
Well, the granddaughter of the architect, Alexandra Beckett, will be on the call. She herself is an interior designer, and I've known her for quite a few years. She will be talking about what inspires her design aesthetic, and she'll also give us a little history of her iconic grandfather and all the legendary buildings that he's built between like Southern California, across the country, and throughout the globe. His name's Welton Beckett. He's actually the master planner of Century City, which is a community that is near and dear to my heart because I used to work there before I came into the Los Feliz area. And so that's something to look forward to. And then on May 5th, on Cinco de Mayo, margaritas will be in order.
Encouraged.
Oh, definitely. Well, we might wear our sombreros and but anyway, we have Bob Horner speaking, and he works with H&S Wealth Management. He has been a guest on our show, on our call before. He'll talk about DSTs, Delaware Statutory Trusts, which are kind of go hand in hand with the 1031 exchange. It's for investors who want to sell their property, but yet not move their money into another physical property. It's through a 1031 exchange, it helps you defer your taxes. So that's also a great wealth building strategy for different people, depending on where they are in their income span and purchasing and what they want to actually take responsibility for. So thank you everybody for joining us, and hope to see you next month and the month after and the month after and the month after.
Thank you everybody for joining. Good to see you guys. Have a good evening.
Thanks, everyone. Thanks, Jocelyn.
Thank you.
Thank you,
Thanks,
Justin.
Bye.
Jocelyn.
Thank you, everybody.